All right. Hello, everyone. My name is Sam. I am from The Blockhead. It is a website I created to help people learn about cryptocurrency and blockchain. And I'm here to do 2 workshops today. The first will be Foundations to Finance. You may be familiar with these concepts. If so, just consider this a refresher. Today's principles that we're going to go through are kind of the basics. We're laying the foundation for some more complex material that's going to come later today, as well as later through the workshop. All right, so there will be some videos throughout this presentation to help break this up so you're not just listening to my voice the entire time. If you have any questions, feel free to reach out to the Blockhead, and let's get started. All right. So to kick it off, when we talk about finance, what we're really talking about is the management of money and other valuables. I think when people think about finance, they just think about currency signs that represent whatever fiat currency that they're using. But essentially, finance is the strategic management of that and other assets. So it is also the maintenance and creation of economic wealth or value, meaning that you can actually make money off of your money that you have. And finally, financial services include currency, banking, credit, investments, assets, and liabilities. And we'll go through these more in depth during this presentation. So to start us off, I love this quote by this economist, Robert Shiller. It is that finance is not merely about making money, it's about achieving our deep goals and protecting the fruits of our labor. It is about stewardship and therefore about achieving the good society. So essentially, when you break this down, finance is not just about money, but it's about access. It is about what can that money provide? Is it emergency medical service when we need it or a loved one needs it? Is it a ceremony that is part of our culture that we want to have? So it really opens up the doors for us in a lot of ways. Now, in terms of today's workshop, we're first going to talk about currency, which is essentially that the money that we use today, how it's evolved, and how it may look in the future. We'll also, secondly, cover banking. So what does our banking system look like today? How could it be improved? Third, we will go through credit. So what is credit? Why does it matter? And fourth, we will go through trading. Now, the financial system is a lot bigger than just these 4 buckets. There are people that go to school for years and years to study finance, financial management, and financial services. So today is going to be a quick high-level overview of these key concepts, but all of these are very essential for what we're going to build on top of it. So the first is currency, and currency is technically our system of money. Now, this can differ between time and geographies. So currency looked a lot different in the past than it does today. It also may look different in one country than another country. And it's also always evolving. So some basics here are that when we think of currency, we think of money. We just kind of equate the two, but they're not exactly the same. Money is something that we give value to, which then becomes currency. There is no intrinsic value. We decide as a collective that whatever currency we're using has value. So for instance, the US dollar, take a paper bill, that actual piece of paper doesn't really have intrinsic value, meaning inherent value. That piece of paper itself, if I stripped away the graphics on top that make it represent the currency, that paper really wouldn't be worth much. And in fact, a little fun fact, dollar bills are actually made of very thin cloth, not even paper. So because we print that stamp on there or whichever fiat currency that you're using, that is what gives it value because we decide, hey, we're all going to exchange this for goods and services within this geographic region. Another point that I really want to drive home here is that money evolves as we do. So we will briefly look back over time what we've used in the past in the next slide, but we must also keep this in mind because the fiat currency system that we use today doesn't necessarily have to be the tried and true practice that we use in the future. So when we look at the evolution of currency, we see that it's changed many times over history. So originally, maybe one group of people were able to sell fish to, operate in their small community, and they were able to trade with another group of people who grew grain. That way, they could both exchange goods and live a more full life. Eventually, as more goods, more services came about, as more groups exchanged different goods and services, they started using more ubiquitous things. In this example, it's seashells, but there have been many things over the years, whether it's salt or spices. And this is a form of currency because it was more even, if you would say. So if I had a cow and I wanted to exchange it for my friend's 3 goats, sometimes that's not really an equal trade, is it? How do you compare goats and cows? So something like seashells or some other ubiquitous item came into the picture to represent this in a more even way. We then graduated from there and we started using things like coins. So what happened here is that we started using precious metals. Now, we use silver, we use gold, we use a few different metals over time, and we stamped them as coins. Now, this is a way to represent a lot of value in a smaller amount. So it was more portable. So if we were sending a ship to the other side of the world, we could send them with gold coins rather than 100 million pounds of seashells in order to purchase whatever we were going after, whichever trade route we were in. Now, we needed something, as the world grew and the world became more globalized, we needed something that was more easily transferable, something that was lighter. We couldn't really, now the world was expanding, the world was maturing, and there was a lot of wealth happening. So it wasn't always easy to carry a ton of gold around. That was also a risk, right? If you have a huge ship of gold, obviously people are going to want that. It makes you vulnerable. So next became paper notes. And these paper notes took many different forms in different areas, but essentially it was a promise to say, hey, I have this much money in storage and I'm willing to exchange this much for whatever good or service they were buying. From there, we have graduated into the system that we have today, which is fiat. And you can see a few different currencies here, but fiat currency is essentially the currency that a government system puts in place for a specific geographic region. You can exchange these between countries most of the time, but this looks a little bit different in every place. Now we're going to watch this quick video to explain a little bit more about fiat and currency.
Hi, it's Paddy Hirsch at Marketplace. So when you hear the word fiat in conversation, you might think, ooh, nice little Italian car. Well, when it comes to money, I'm sorry, but nice little Italian cars are not what we're thinking of. So where does the word fiat come from? Well, back in the day, if you took $1 and walked into a bank a long time ago, you used to be able to get a certain amount of gold for that dollar because a dollar was worth a certain amount of gold. Of course, if you tried that today in the United States, you'd get laughed out of the bank. And the reason is because a dollar is what's, like most currencies, is what's called a fiat currency or fiat money. So what does that word fiat actually mean? Well, it comes from the Latin, let it be done. So if you're familiar with the phrase royal fiat is when the king or the queen, someone in power, decides that they want to do something. They do something by royal fiat. So the king might say, I want everyone's gold in the entire realm, let it be done. Because he's the king, everybody does it. That's kind of what happened in the United States whenever the government decided to take the gold standard away from the dollar. So it actually decoupled the value of a dollar from the value of gold. And then the government said, this is worth $1's worth of goods and services backed by the United States government. So it's not really worth the paper that's written on. It's only worth what somebody else is prepared to give you in return for that dollar. That's really all it is. So because it's not backed by gold and silver, this is great news for the government, because the government can now go out and crank out as many of these as it needs to fund a war or to bail out a bank or whatever. It's great news. It's actually pretty good news for us as individuals, because it means that now that our currency isn't tied to the value of a commodity like gold or silver, it means it's not going to be quite so volatile as it has been in the past. The bad news, of course, is that if the government prints lots and lots of those dollars, vast amounts of money goes into the system, it means you've got more dollars chasing fewer goods and services. And that can lead to inflation, where the value of your dollar is worth a lot less. And of course, that can also lead to hyperinflation, where the value of your dollar just falls off a cliff because there's just so many dollars chasing so few goods and services. And when that happens, it can leave us very badly needing a drink.
All right, we're back. So this nice man explained a little bit more about fiat, but it does touch on our next concept here, which is inflation and deflation. So when we talk about this, what we're really talking about is the difference in money supply. So with money supply, when this video, we'll talk about it more in depth, so we'll get another little break as we watch this, but essentially this is a really key component that will lead us into the importance of blockchain, the importance of cryptocurrency. The money supply is controlled by whoever is operating the fiat currency. So if they influx and they print a lot of money, then we have much more money in circulation, much more currency within that region. If they take money away, then that money's value goes up. So this video does a little bit better of an explanation. Here we go.
Pencils, and the total money supply was $4. Each of the pencils would cost $1. That inflation is desirable. That it's positive for the economy. Central banks are not happy when inflation doesn't reach the desired level. But is it true that constantly rising prices as a result of monetary inflation is good for us? First, let's explain the phenomenon itself. To put it as simply as possible, if the only goods in the world were 4 pencils and the total money supply was $4, each of the pencils would cost $1. If the central bank would then create another $4 and the amount of pencils does not increase, how much would a pencil cost now? Exactly, $2. Monetary inflation is an increase in the quantity of money. Monetary inflation is not the same as rising prices, but the two are related. The popular definition of inflation as an increase in the general price level is not complete and doesn't tell us the main cause of rising prices. We see the general rise in prices when the money supply increases faster than the demand for money. Price inflation, then, is often a consequence of monetary inflation. We can also have monetary inflation without increasing prices. This could happen if the number of dollars and the number of pencils increase by the same amount at the same time. We can also have rising prices without inflation if the amount of money remains unchanged and a natural disaster or a war destroys 2 pencils. Most often, however, monetary inflation is accompanied by an increase in prices, although the process is not immediate. So why is monetary inflation and, in effect, price inflation bad for us? First of all, because it diminishes the purchasing power of our savings and salaries. Inflation is a hidden tax. It is hidden because you see the same amount of money in your account, but with a 10% increase in the price level, you will be able to buy 10% less stuff. Debtors, however, benefit from inflation. The value of their debt falls as much as the value of savings. Most governments in the world are heavily indebted, so inflation is convenient for them. At the time of borrowing, the money is worth more, or buys more than at the time of repayment. Inflation, therefore, discourages savings and promotes consumption, because it is better to buy today if tomorrow everything will be more expensive. Another effect of inflation is an increase in wealth inequality. Newly created money is not distributed equally through the economy. Those who get the money first have the advantage because they can buy before the price inflation. People who get the money last are in the worst situation because they are most affected by its falling purchasing power. Monetary inflation is the opposite phenomenon. It's a reduction of the money supply. Using the pencil example, if a bank takes out $2, each pencil would cost 50 cents. Monetary deflation results in falling prices. It rewards people with savings because the purchasing power of those savings grows over time. It is a problem for debtors, however, because they have to give back money that is worth more than the money they borrowed. It also causes a decrease in liquidity which results in more cautious investment decisions. Deflation is therefore advantageous for people that manage their money in a conservative way. Price deflation may also occur without monetary deflation. For example, if the money supply remains the same and the number of pencils increases because of an increase in productivity, is such a decline in prices a bad thing for anybody? After all, we want everything to be cheaper. Perhaps this phenomenon is good for consumers but not for producers. Let's have a look then at the manufacturers of computers, cell phones, and cars. When production was less effective, only rich elite could afford such inventions. Thanks to an increase in productivity, due to the introduction of new technologies, manufacturers were able to produce these things faster, cheaper, and in greater quantities. Now many more can afford a computer, a phone, or a car. Not only are these things more accessible, but they also are much higher quality than at the beginning. Can we say that the manufacturers of cars, computers, and cell phones are poorer because of that? Of course not. So maybe a continuous decline in prices is bad for the economy. Will people indefinitely put off the decision to buy something because in the future it will be cheaper? Will the demand for everything completely disappear? Think about it. We know that every year computers can be bought cheaper or at least much higher quality for the same price. Does this mean that we will not buy a computer if we need one? Of course we will buy one because we need it now and not a year from now. Will we indefinitely put off a decision to buy food knowing that next year it will be cheaper? For obvious reasons, no. For the economy and the people, the best solution is a stable amount of money. The amount that cannot be increased or decreased in a sudden manner by the whims of central bankers. The money available on the market should be controlled naturally by how much we spend and how much we save, and thus how much money is actually available to finance investments. Market mechanisms will then force commercial banks to determine the appropriate market interest rates. Also, decreases in the price level due to an increase in productivity should be a natural and welcome consequence of economic growth. We would have steady deflation if the central banks wouldn't increase the money supply. Visit us on econclips.com where you can find other films.
All right, so I know that may seem a little confusing. I think it touched on a couple different topics that I want to talk more in depth about, though. At the end of the day, even if this whole video just completely lost you, I think what's important to get from it is that inflation is when there's an increase in money supply and the value of that money goes down as an effect. And because the value of that money goes down, that means you need more money to buy goods and services because your dollar is perhaps worth less. Deflation, on the other hand, is when the money supply goes down, meaning the value of that money goes up and you can actually buy more with that money over time. So this is a very key concept because this is what's happening right now in the United States. So let's see if I can do this. No, okay. Basically what has happened in the United States from the currency video, you remember that the US used to peg, what they call the US dollar to gold, meaning that to print more money, the US had to have more gold in storage in order to do that because the dollar was basically linked back to gold. Now, what happened in history is that after World War I and World War II, a lot of currencies were up and down and all over the place. A lot of countries needed to print more money in order to make repairs and reparations. But what happened is that the valuations of those currencies were all over the place. So a certain event called Bretton Woods happened. Now this gathered representatives from countries all over the world to come together and figure out how do we make a more stable global currency system. There's a lot of debates. There's a lot of arguments. It's a very interesting event if you want to look into it more, just from a historical perspective. But basically, the outcome of that was two things. One, most currencies would be based on just one fiat currency. And two, that fiat currency would be pegged to gold. So what came out of that is that they decided the United States dollar would actually be the one currency that other currencies are based off of, and that the US would be based off gold. Now, fast forward in time, in 1971, Richard Nixon was president, and it was post-Vietnam War. Now, the US needed to print a lot of money to make up for how much they spent during the Vietnam War, and he made a decision to unlink the United States dollar from gold. So from 1971 on, after this decision was made, it forever linked fiat currencies and politics. So our fiat currency money today is completely controlled by different governments, and it's not necessarily linked directly and totally to gold. Now, this varies depending on the fiat currency that you're talking about. Some are linked to some precious metals. Perhaps 10% of it is linked to gold, while the rest is market forces. But the US dollar is not. Now, I mention this because the US dollar is the most used currency today. But because of recent events like COVID-19, the US has printed more money in the last year than they ever have. What does that mean? As we saw from this last video, because of this influx of money supply, more than the system has ever seen before, we expect inflation. So we expect the value of the US dollar, as well as the value of other currencies, to go down. Now, I know that was a lot. Currency is definitely our heaviest topic today, but all of that is really key for everything that we're going to build on top. So second, we're going to touch on banking. And essentially, when we drill this down, it means where we put our money. Now, it's a very complex system, but a bank, when we talk about just one specific one, has a few key concepts. So first, a bank is where people deposit money. They trust this bank to keep their money safe, and they're able to pull it out when they need to. Third, the bank actually lends out money that it has within storage as loans to other people that they deem trustworthy. And the bank makes money off of the interest paid on those loans that it gives out so that it can keep operating. And so you can see the cycle that works here for banks. This is how they make money. This is how they operate. This is the service that they provide. Now, this video is going to talk a little bit about banking. It's going to talk about our current system today. And it's also going to talk about a couple of problems that have happened in the last few years as well.
The international banking system is an enigma. There are more than 30,000 different banks worldwide, and they hold unbelievable amounts of assets. The top 10 banks alone account for roughly 25 trillion US dollars. Today, banking can seem very complex, but originally, the idea was to make life simpler. 11th century Italy was the center of European trading. Merchants from all over the continent met to trade their goods, but there was one problem: too many currencies in circulation. In Pisa, merchants had to deal with 7 different types of coins and had to exchange their money constantly. This exchange business, which commonly took place outdoors on benches, is where we get the word bank from the word banco, Italian for bench. The dangers of traveling, counterfeit money, and the difficulty of getting a loan got people thinking. It was time for a new business model. Pawnbrokers started to give credit to businessmen, while Genoese merchants developed cashless payments. Networks of banks spread all over Europe, handing out credit even to the church or European kings. What about today? In a nutshell, banks are in the risk management business. This is a simplified version of the way it works. People keep their money in banks and receive a small amount of interest. The bank takes this money and lends it out at much higher interest rates. It's a calculated risk because some of the lenders will default on their credit. This process is essential for our economic system because it provides resources for people to buy things like houses or for industry to expand their businesses and grow. So banks take funds that are unused by savers and turn them into funds society can use to do stuff. Other sources of income for banks include accepting saving deposits, the credit card business, buying and selling currencies, custodian business, and cash management services. The main problem with banks nowadays is that a lot of them have abandoned their traditional role as providers of long-term financial products in favor of short-term gains that carry much higher risks. During the financial boom, most major banks adopted financial constructs that were barely comprehensible and did their own trading in a bid to make fast money and earn their executives and traders millions in bonuses. This was nothing short of gambling and damaged whole economies and societies. Like back in 2008, when banks like Lehman Brothers gave credit to basically anyone who wanted to buy a house and thereby put the bank in an extremely dangerous risk position. This led to the collapse of the housing market in the US and parts of Europe, causing stock prices to plummet, which eventually led to a global banking crisis and one of the largest financial crises in history. Hundreds of billions of dollars just evaporated. Millions of people lost their jobs and lots of money. Most of the world's major banks had to pay billions in fines, and bankers became some of the least trusted professionals. The US government and the European Union had to put together huge bailout packages to purchase bad assets and stop the banks from going bankrupt. New regulations were put into force to govern the banking business. Compulsory bank emergency funds were enforced to absorb shocks in the event of another financial crisis. But other pieces of tough new legislation were successfully blocked by the banking lobby. Today, other models of providing financing are gaining ground fast, like new investment banks that charge a yearly fee and do not get commissions on sales, thus providing the motivation to act in the best interests of their clients. Or credit unions, cooperative initiatives that were established in the 19th century to circumvent credit sharks. In a nutshell, they provide the same financial services as banks, but focus on shared value rather than profit maximization. The self-proclaimed goal is to help members create opportunities like starting small businesses, expanding farms, or building family homes while investing back into communities. They are controlled by their members, who also elect the board of directors democratically. Worldwide, credit union systems vary significantly, ranging from a handful of members to organizations worth several billion US dollars and hundreds of thousands of members. The focus on benefits for their members impacts the risk credit unions are willing to take, which explains why credit unions, although also hurting, survived the last financial crisis way better than traditional banks. Not to forget the explosion of crowdfunding in recent years. Aside from making awesome video games possible, platforms arose that enable people to get loans from large groups of small investors, circumventing the bank as a middleman. But it also works for industry. Lots of new technology companies started out on Kickstarter or Indiegogo. The funding individual gets the satisfaction of being part of a bigger thing and can invest in ideas they believe in, while spreading the risk so widely that if the project fails, the damage is limited. And last but not least, microcredit. Lots of very small loans, mostly handed out in developing countries that help people escape poverty. People who were previously unable to get access to the money they needed to start a business because they weren't deemed worth the time. Nowadays, the granting of microcredits has evolved into a multi-billion-dollar business. So banking might not be up your street, but the bank's role of providing funds to people and businesses is crucial for our society and has to be done. Who will do it and how it will be done in the future is up for us to decide, though.
All right. So that video did a pretty good job of explaining just the different types of banks, what's happened in recent years. A couple of things I want to recap. I think first and foremost is the financial crisis. So we saw there a direct example of how kind of politics is linked with fiat currency, how governments are able to have such a strong hand in the economics play, which can be a good thing, but it can also lead to a lot of harm. So I think what we saw is that these big banks that were not doing the most ethical of practices were actually bailed out and saved, while most of the people that were affected by this economic crisis were left to suffer. Now, from that, we can see, they covered credit unions, microfinance, a couple of different ways that banking works, and different models. One other thing that it touched on that I really want to emphasize here is crowdfunding. So this is a pretty new concept that's happened in the last 10 to 20 years. It's picked up a lot of steam. There are websites like Kickstarter and things where anyone can say, hey, I have this idea for a business or for a product. And if you believe in it, you can become kind of an early shareholder and donate money. And if we do well, you get something back, depending on the level of money that they invest. So this is really key, this kind of crowdfunding methodology, because it's really gave way to a whole new other set of businesses that we'll get into at a later workshop when we talk about cryptocurrency. But something that's really key that I wanted to touch on here. So the third one here is credit. We will cover this quite lightly. It can get very complex, but why credit matters at the end of the day is that it is purchasing power. So credit is when you borrow money because you need it to make a purchase, whether it's a car, house, education, maybe you want to start a business, and you need funds that you don't have yet, but you want to do these things. So essentially purchasing power. Now, this then feeds into financial reputation, because if you can pay that loan back, the credit that you took out, if you can pay that back consistently, then you show that you have reputation. You show that you're a trustworthy person to lend money out to. This is a very key concept because of the word trust. So if you've noticed so far, trust has been a kind of a key theme through all of these financial principles. With banks, we trust them to hold their money, and then they lend out that money to other people, and then they trust those people to pay the money back, so that you can always kind of pull out cash as you need to. You never need to worry about the bank just losing all your money. However, like one of our videos touched on, Cyprus was a country that actually suffered from this because it got to a certain point where banks just could not pay the money back to their people. This then led to a collapse, a banking collapse, if you will, because although people put all their money into the banks, what happens when they can't pull it out? So to really bring this home to an individual perspective, there's a book called Bitcoin Billionaires that details this, and it follows the story of a mother. And she gets up one morning, her kids are asleep. She wants to go buy biscuits for the family, and she goes to the bank to pull out money. She finds a giant crowd outside the bank, and no one can pull out any cash. No one has access to their funds. The banks are closed. And at first she thinks, is it a holiday? Why are the banks closed? But what happened was that was actually the collapse. And this is a huge problem. So although this only happens with certain environmental factors, whether it's with the government or the banks or a greater economic story, this is a risk at the end of the day, and has also led to why we are now in this blockchain cryptocurrency type world. So fourth is trading. Essentially, trading is putting your money to work. So the money that you do have, you're making money off that money by trading. Now, trading is really broad. These are some different types: the stock exchange or trading stocks, day trading, swing trading, Forex, so foreign exchange markets, making money off the different currencies that, their valuations change, derivatives, and then long-term trading. Now, there are many more, and trading itself could be a whole week's worth of workshops. And so we certainly won't dive into every single one of these, but we will talk about these two. The first is the stock exchange, and the last is long-term trading. Now, I wanted to focus on these because these are going to be essential to know before we get into more complex things like cryptocurrency and blockchain. So the first is the stock exchange. Now, the stock exchange started on Wall Street in New York when one person said, hey, I have this company. Do you want to buy a share of this company? Meaning you own a really tiny piece of it. And if I do really well, we both get to profit because you're technically a shareholder. That person said yes. They gave the person with the business a little bit of money in exchange for a piece of that company. Now, although that's how it started, it has now grown into a massive, massive industry. Now people can trade stocks throughout the day. They can pay people to invest on their behalf. You can also do things like indexes, derivatives here, where you're trading on trends or trading on other parts. So it's really built up like this over time. It's turned into a massive, massive business. There do tend to be cycles. So there do tend to be years where the stock exchange does really well, perhaps certain sectors do really well. In recent years, technology has really taken off as we've seen the growth of things like Facebook, Google, Amazon, things of that nature. And other industries haven't done so well. So when you look at the top 20 performing companies on the main stock exchanges in the world, they used to be companies like PG&E or oil companies, General Electric, things like this, things that were representing the main goods being purchased at the time. Now, however, when you look at it, it's mainly tech companies or electric-based companies like Tesla. So something important to remember as we move forward, but not necessarily something that you need to dive into or master by any means. And the next is long-term trading. So another way to think about this is holding, as if you're holding a piece of something for the long term. So this is important when it comes to cryptocurrency, because when you're holding something, it means that you have the belief that whatever asset you are holding on to will increase in value over time. So an example of this could be, I am passed down a gold nugget from my grandmother. I don't actually have one, but let's just say I do. And I might think that gold will retain its value or go up over time. So I just hold on to it. I keep it in my house, or maybe I bury it somewhere. I don't know, wherever I think it's safe. That's technically a form of long-term trading. It's just holding it until a later date when I think it will be worth even more than it is today. And then if I need to trade that in for currency because I want to exchange value, like buy a house, buy a car, buy a lot of food, then I can do that. So another example of this is something that you might have heard of, but it's Bitcoin. And it is new cryptocurrency that people believe will increase in value over time because of deflation. So we touched on this before, but as a little refresher, deflation is when the supply of a certain currency is fixed or it goes down over time, which means that the value of that currency will go up, meaning that each one of whatever that currency is will actually have more value and you can have more purchasing power from it as time goes on. So it's very common for people to hold Bitcoin because they believe that the price of Bitcoin will continue to go up. Now, why would they want to hold on to it? Let's say it's higher than yesterday. Why would they just spend it then? And it's because they believe that it will continue to go up. And so for them, perhaps they don't need it immediately. And if they did, then maybe they would trade some of it. Or let's say if we're talking about that gold nugget example, if I needed the funds right away, maybe then I would trade that gold nugget in. But long-term trading means you hold on to it until you really need to exchange that for a medium of exchange. And that actually touches on two concepts that I also want to talk about. When we talk about money, there's different ways we can talk about it. There are many, but two key ones are, one, a store of value, and two, a medium of exchange. With this example of long-term trading, we've touched on both. So you might have an asset that you keep as a store of value until you need to spend it, and then you would exchange it for whatever you need as a medium of exchange. Because if we go back to that gold nugget example, I won't be able to take that gold nugget to the store and say, hey, I want to buy a car with this, or I want to buy 100 ears of corn with this nugget. that merchant probably doesn't take gold nuggets as a form of currency. So I would then have to go somewhere, exchange that gold nugget for whatever medium of exchange that the person with the good or service is using, and then go to them with whatever currency is used. And that's where the medium of exchange comes in. So you can see how these two different types work. They don't just deal with Bitcoin and gold nuggets. There are lots of ways that we store value, including fiat currency, the money that we use today, depending on where you live. And then there are lots of mediums of exchanges as well. Another topic that we touched on was credit, and that is also considered a medium of exchange. So one thing that we didn't totally touch on today, but it's credit card companies. So essentially, you are buying and exchanging goods and services on credit through a credit card company with the promise that you will eventually pay that back with whatever you have as a store of value. So I hope that helps kind of explain those and explain trading types. Really what this all goes into is that we are entering a new financial era. So I know that this has been a lot of information on our current system. We've touched on a couple of issues that we're seeing in terms of currency, the supply of currency and how that fluctuates over time, which then fluctuates the value of the money that we have and what we can do with it. I know we also touched on the financial crisis that happened in 2008 and how that kind of had ripple effects on markets all over the world, how the decisions of centralized banks and financial services can have much greater effects depending on the decisions that they make. And also some opportunities in the future and where we're going. So we are now in, what people like to call Web 3.0, meaning that because of the internet, we can do things like this, where I am located in the United States, but I am able to teach these principles over StreamYard, Zoom, YouTube, Facebook, and you're able to understand and listen to them at a much greater length in a completely different country. So we've also entered, the era of social media. We're able to communicate quickly and directly with pretty much anyone in the world if we have an account or access to that through something like Facebook, email, what have you. So it makes sense then that we're entering a new financial era because we have these different tools. We're more globalized than ever. We can communicate more quickly than ever. So why is our financial system still siloed? Why is it still cut off by different geographic regions? Why do some people have access to financial services and others do not? So we can see from today's workshop that this system we have today is just ripe for innovation, and we're already seeing a lot of new opportunities, a lot of new technologies emerge. So today's group work, you will have about 15 minutes to talk about this. Gather in groups of 5 to 10. This is completely informal. This is just a discussion. You don't need any paper and pencil type things unless you want to record notes. Also, if you're in a smaller group, feel free to just do this on your own, whatever you're comfortable with. But really what I want you to think through is what kind of financial services would serve your community best. You get to decide how you want to define community, whether that's your immediate community or town, whether it's the major city that you're in or your entire country or entire continent or the entire world. However you want to define it, what would serve it best? And then from there, you can you can come up with one idea, you can come up with a list, but the next piece will be crucial. And that's if you had a magic wand and could do anything, create anything, which financial services would you create in your community and how would they actually function? So we talked a lot about different financial services throughout this workshop, but really think through, okay, if I created this, how would this work? And then discuss this. There are no right or wrong answers. There are no dumb or bad ideas. So please feel free to get creative, talk, and I will be back for the second workshop in about 15 minutes. Thank you.